Hello, YouTube. Jerome Powell spoke, NVIDIA reported earnings, and the S&P closed green, led by big tech. We can note that we have a pattern here, which we're going to talk about right now, which is something that I don't think people are going to believe. Let's see whether or not you agree. So here we're comparing 2007 over to 2023, as you probably saw in the thumbnail when you clicked on the video. This is going to be a very interesting update because all we're looking at here is basically that we form higher lows after testing the blue line or the 50 moving average. As we keep forming those higher lows, notably with lower wicks, well, we just keep going higher until we don't. Over here in 2023, we got 1, 2, and then we got a question mark. So that's really what we're going to go through this weekend. At a high level, we're just basically looking here at a pattern which also compares to 2020, where we have a 4-step recipe. And now with an update on that right now, we're basically here at number 4, where we just want to know whether or not the pattern is going to continue. So again, you can rewind, pause the video if you want. We're just going to push forward like you know what's happening. So in number 4, we have 2 red candles here. And so far we got 1 red candle. And now the most important part for me is just this note right here where it says, can we close over the previous monthly low, right? Can we hold it? Apparently I can't type, so I apologize about that. But anyways, looking to here, we're looking at these 2 red candles. So we have 1 red candle so far. And the most important thing for me is going to be whether or not we actually close back above the previous monthly low. So over here, it did. We ultimately formed that lower wick, ends up being a buy the dip. Over here right now, that would mean for SPX, that's 4385, so 4385. And right now we're above it at 4400. So it's going to be important as we're closing out this monthly candle, what's going to happen. But the pattern's intact. And this would ultimately be a bullish pattern because it does lead to that all-time high. So that's why in the video we say something's happening that you might not believe, because at a high level, it could be 2007, where another way to think about this is we raise the interest rates during 2004, 2005, a lot slower. We get to a peak rate, then we pause for 1 year from July of 2006 to July of 2007. Rates stay at the same area, and then they start going lower, and then the recession happens, which is why we say most declines happen after the Fed pivots, not when it pauses. So I think we're getting to a point where we're going to keep going up. We're at 5.0 over back here in 2006. We're at 5.25. They do one more time. They don't do one more time. I don't think it really matters. It's the point whether or not we can flatten out. So if we flatten out here and then we go sideways for up to a year, like in 2018, it was short. Jerome Powell was in charge then. So let's not forget that. But we'll come back and compare this. Can we go sideways for a year? Well, sideways for a year means like, man, that could be 12 more candles. And the bears could be ultimately right. But man, could they be really wrong? And could it really hurt in the short term? So that's what we're going to talk about right now. We went through the pattern. Can we hold or close over the previous monthly low? Not can we start? So Jerome Powell, what's this guy? What's he doing? What's he going to tell us? Let's look at a little bit more data. But just before we do that, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really appreciate that. We put a lot of effort into these videos, and we just like for you to be a part of our YouTube community. We do put out videos every single day. So here's Jerome. Jerome Powell signals Fed will raise rates if needed. Keep them high. Fed in position to proceed carefully. So look at this. Look at this picture here. It looks like he's a little perked up, right? He's a little bit perky, like he's just not sure what to say. I'm going to talk a little bit more about that in a moment, so just bear with me, and I think we have a great show for you. Fed is in position to proceed carefully at upcoming meetings. Stronger economy could push up inflation, warrants higher rate hikes. Then what we're just going to look at here is this next article, and it just talks about stocks rally. Stocks rally has a way to go before Americans feel rich again. So this is the part where there might still be a little bit more fuel in the tank. I'm going to jump down to this graph right here, which shows us that the S&P, meaning the lines we're looking at here, like the line charts, basically the candles, right? Another way to think about it. That's different than the way that the market cap versus the GDP is compared. So we're going to look at some more figures, including GDP. We're going to look over here at GDP versus GNP to compare 2007 to now as well. We'll look at this thing called the U.S. debt clock. We'll go through and talk about a debt cycle, which could happen in 2024, the ramifications, and all the good stuff from the 10-year note. So I think there's a lot to go through, but let's try to keep things simple and go back to the narrative here. So we're trying to understand whether or not this could be happening here. I want to make this very clear because I'm not sure it actually will, which is why there's a giant question mark here. But I think that I laid this thesis out. I didn't know if it would ultimately happen, but it is. And if it keeps happening and we're over the short-term price or that 50 MA, I don't see why us being about right here and then we just keep going like a lot higher from the second low. Second low was only here at about 1100. We ultimately go to about 15, 1600. That's a lot of room to the upside. Ultimately, the bears do get their 50% drop. Where do we go? Right back to where we started. So their lows are where we were buying in at the highs in this period. So we go up. The bears are ultimately right. But if they started shorting in this period, man, they didn't make anything. They have to short it up here. So when we stop putting in higher lows, that's the part where we get bearish. Until then, I can see the bull thesis here. And because we have all these competing patterns, I think it's just really important that we keep in mind that if we look here to our weekly pattern, it's still intact here. This is the bear thesis for us to have a crash on the weekly chart, a crash after a dead cat bounce. So if we go through this one a little bit differently here, 3 weeks down, 1 week up, there's your leg lower. 3 weeks down, one leg up, there's your move lower. And in both cases, we print the higher high and then we go lower. Why? Well, because we closed somewhere near the high of the week here, somewhere near the high of the week. Well, in this case here, we did close green. It is a hollow candle, but it's an inside bar. So I would not say that this time is the same as the time where we have the green week or where we have the green week. I would also say it's not the same as the other periods here, which we're going to now look at a little bit closer, where we just have straight red weeks. We got like 6 or 7 in a row. Right here, we got 4 in a row. Here we got 3. So here we got 3. And then the dead cat bounce. So this time it's different because we only have 3. But I think what's really happening here is that we're down by that 5%. And what this really comes down to is what we mentioned before is like, if we need to go down, what's the percent? What does history tell us? And I'm just trying to pull up that graph here. So give me 1 second. Here we go. So this one right here, it gives us very clear numbers where if we have a look, only 15% of the time, the 5% drawdown is sufficient after a 20% move, which we've already had. So the fact the S&P is holding up right here is like pretty impressive. We're down by 5%. That's the white line. So 3 red weeks, bounce off 5% down. Now, because we have an inside bar, if we ignore everything about the bear market and just look at this current candle, let's make it really, really, really easy or simple to understand. Instead of trying to make a very complicated story, we just have an inside bar, which means whatever happened this week, regardless of the price, it doesn't matter what I think about what Jerome said or what he didn't say or what the market should do. All that matters is what did happen. So what did happen is that we held the range from the previous week, which is why we have an inside bar. We have a hollow candle. So in this next week, I want to see whether or not we get a tighter coil. A coil just means that we're ultimately going to get an explosive move one way or the other, up or down. But until we break the range here on whatever news happened, I think that I just want to see that bar break, inside bar break. So if we have consolidation, then we break the range, just like here, right? Bullish engulfing, that led to a leg higher. I don't know what's going to happen. So let's just look and see what happens on this inside bar break. So we're laying out a pretty bullish story, which I don't think a lot of people are going to believe, which is the reason why I want to present this. So let's go through a little bit deeper now. So there's a ways to go before America feels safe. And there's a pretty big number right here. And that's because in the face of high inflation, the drawdown is about $2 trillion of that savings. The U.S. consumer has drawn down about $2 trillion in cushion that they built up during the lockdowns. And then when we look here to another article, U.S. consumers near a day of reckoning as their cash stash shrinks. Poor households already feeling strained from pinched finances. Economists divided over whether stresses will spur a recession. So there's clearly a story of two Americas. But when we think about the stock market, we looked at it in terms of when we looked at it in the article, here we're looking at it in terms of GDP. So clearly, inflation is a tax, and that's what people are feeling, right? It costs more than what your stocks are worth. So there's that way of looking at it. And then this way here, we can see whether or not the recession is going to happen for wider America. Here in earnings, they've actually been able to beat, and that's been good, right? So earnings per share don't look all that bad. So now we look at the next graph here. It tells us that, okay, we got GDP. GDP here is at 5.9. So what I heard from Jerome is a lot of what I would call jawboning. So jawboning means that it's an attempt to, again, listen to the words intentionally here, attempt to persuade or pressure by the force of one's position or authority. So what does that mean? Well, there's even an example right here. The Federal Reserve Board Vice Chairman jawboned the dollar higher by calling a recent state blah, blah, blah. So Jerome Powell's talking a strong game, right? That's why he looks like he's a little bit perked up here, right? Look at those lips. He's like, "Yep, I'm puckered up. I'm ready to release more if needed." But I don't think he wants to. So I think that what he's doing is jawboning or trying to make an attempt to just make the market do what he wants, because this is not what he wants. This is too big. It's too high. That's not good. Inflation's low, but this could be where we get that second wave of inflation. So I think he's trying to talk a big game, and it's worked. We've talked a lot about this. A week of 1% moves on the S&P could trigger forced selling. There's been a lot of forced selling. How much? 28.8 billion is probably done now. So let's just keep the story going. What happened? We were in extreme greed a month ago. Then we went down to neutral. Then we went to fear. Now we're back in neutral. What does that mean? We went down into fear. We dead cat bounced back up. Sorry, we started in greed. Sorry, extreme greed. A month ago, we're in extreme greed. We went all the way down to fear. Now we're dead cat bouncing back up. If it's going to turn into a reversal, we probably have to get back into greed, which is the same thing that weekly chart tells us here. So this weekly chart tells us that if we're able to break that inside bar bullish, maybe that's it. The 5% dip is all we need. We don't need to do what we did before any previous time. That would be like a pretty good thing to be aware of. So if that inside bar on the weekly chart for the SPX breaks bullish, like we've already seen on QQQ, that could be it. And another way to look at this is that we're going to look at the QQQ or the Qs. We're looking on the daily chart here. This just shows us the dominant trend. So before we were going down, now we're going up. So that's the dominant trend. And then what we look at here is this yellow box where when we hit the uptrend, like we hit the uptrend here, we bounce. The difference here is that these are all green candles that go straight to a higher high. The difference here is that this has been a choppy road, massively bearish engulfing candle. So until we get back above that price, like the bears are on the offense, but the bulls have been doing really good defense. So we have to be mindful of the short-term versus long-term potential, because this pattern here implies that this goes out for a couple of months. So 2 months of consolidation before we go higher. I think it's healthy to have some digestion, like after a really big Thanksgiving turkey dinner. Sometimes you're like, you know what? As much as I would love to have another slice of pie, I just can't do it. So that's what I think is important to keep in mind. So we talked about Jerome jawboning a lot. We looked at the number over here. Does it really matter if he goes to 5 or 5.25? I don't think so. The part where we go sideways is that euphoric part for the market. As soon as they make a cut, I mean, something's probably breaking, and then something is broken when we get into the recession here. Boop. So we've gone straight up. Now we can probably go sideways. I don't know if there's going to be like an imminent crisis. We already had the SVB. And at least for right now, things don't look like that terrible. Are they rosy and great? No, we know that. And that's the reason why we can go up. So 28 billion. And then look at this article right here. And this is, I forgot to mention this earlier. Could Fed Chair Jerome Powell's Jackson Hole speech send stocks plunging again? Well, that's what everyone expects. That's why we went to fear, extreme greed to fear, because they're like, oh my God, he's going to crash the market like last year. Please don't do it, sir. Please don't do it, Jay. And we're not sure that he has or hasn't yet. The fallout is an inside bar in the weekly. We don't see that bearish break yet. If we're going to get that bear market, it just takes another push down. If we're going to get the 2007, it's like, well, as much noise as these bears are making, they need to break the chart, which means they need to destroy it. They broke the daily chart by getting below the 50 DMA, but that's about all the progress they've made. If we look here, again, let's just try to be a little bit objective now. So we're looking at 2007 versus whatever here. If we go to the most recent period here, there is a pattern here that is a head and shoulders, and we are below the 50 DMA, but we're still pointing up. So this part right here, it's a nice pattern. Look at the amount of time on the chart, though. So it's the box. It's not very big compared to the box, which shows the uptrend, which started back in October. This box here is massive. So what does that mean? As much as we might pay attention to the short-term pattern, it is very small compared to the wider pattern here, which has a lot more significance. And we remain above key support, which used to be resistance. So resistance turned into support, which usually means that we've flushed out all the sellers who want to get out. And if we can leg up and get, again, there's a lot of ifs and ends here. Like let's be honest. Then we're not sure. This could be a W, or we could go higher, or it could be that head and shoulders. I'm not sure. I wish I could have that crystal ball for you. So I'm just trying to be objective, because over the course of a period of months, we're probably going to see that daily chart get whippy, sometime below the 50 MA, sometime above. A lot of forced selling on a week of moves, 28 billion. There's going to be more. We're probably going to want to know about that. And the shorts have been Like we joked about it before. Are they going to go net long? So short double down, go net long. Short double down, go net long. Short double down. Are they going to go net long? If we look here to the shorter period, we note that we have the peak at 400,000 contracts. Then we go to 250. Now we're hovering here around 100 and some change. So it's looking interesting. If they go net long, that's the fuel for us to do the 2007 where we just go higher and no one believes it. So that would be an incredible move. Jerome might do it. All right, so what I want to do in a moment here, let's actually just close all this stuff out. I think we laid the case out. Let's delete that. Let's actually go back to here. So 1 week performance is helpful. If we look at the last 1 month, here's where the story is going to have to change. And we're going to see this on the charts. So we look at the 1 week, which signals there's a dead cat bounce. I'd like to see for it to look something like this when we do the video next weekend, because the 1 month performance is telling me that we're seeing that we're getting some pretty big cuts. Apple and Microsoft notably below their 2022 and 2021 highs. That's a big deal for me. Year to date, it's pretty fantastic. Let's be honest, 30% for a multi-trillion-dollar company is pretty good. Same thing for Apple, 37%. Google at $1 trillion, 1.6, right? Nvidia at $1 trillion too. It's impressive, not going to lie. So let's talk about a few more things in the comparison that we're making to 2007. So there's this period of we're pausing. We're not quite yet at the point where we are ready to actually pivot. So that's what I pretty much heard from Jerome today. We want optionality. We're not ready to declare inflation is a victory, right? That would mean that we're going to be going sideways. He didn't tell us we're going sideways yet. He's kind of telling us, hey, maybe we're here. Well, here or here, which means May or July of 2006, doesn't really matter. Why? Well, it doesn't matter just because relative to where we are on the chart. And I think like one more thing we can try to think about here. Actually, when we go back to the charts, we'll talk about it. We're going to look at the GDP now, which is a way of trying to forecast what the GDP is now. This is one way of trying to look at the GDP. So we're looking at it here, and then it shows here there's clearly an acceleration happening, right? 5.9. It got revised again on the 24th. We talked about that. That's a big number. We go here to GDP divided by GNP, or gross national product. So GDP, gross domestic, divided by gross national product. We look here. The period I'm focused on here is 2007. So when we look here to our current period too, if we divide the GDP divided by the GNP, we can see it's clearly pointing down. And that's what that Bloomberg article kind of showed us with the GDP divided by the stock index. So we're pointing down, and right here we're pointing down. And then the great part is the recession of 2008, right? The Great Recession, they call it. So we have our high, we have our lower high, we start like fading, boop, right? There's the recession. All right, well, this chart looks a lot different than this one. This one shows an acceleration. This one shows, I'm not so sure. That doesn't look good to me. And then the more interesting part, if we think about, so now we're going to delete this one. We're going to remove the GDP. So GDP, I'm going to put an asterisk beside that one. When we compare the debt load of yesterday, meaning when we were going higher here to a terminal rate somewhere. Terminal rate just means where do they stop raising interest rates, where we start going sideways. It's about 5.25. Here we're already at 5. So the difference is when we look here to the 2000s versus now in terms of the cost of the servicing the debt. So looking here at 2000 to like 2000-ish, the average debt to GDP, we looked at GDP divided by GNP, remember? This is called usdebtclock.org. It shows a massive red number. All I'm focused on is this number right here. U.S. Federal debt to GDP ratio. So in 2000s, it was 56%. Now it's twice as expensive. So even though this only appears like a double top here, it means that the debt servicing is actually a lot higher. It's twice as high. So this is a little bit deceptive when we look at only this. And now I want to think about another reason why this might be delayed until 2023. So we're seeing an acceleration in GDP. We're seeing a GDP divided by GNP showing something that's wrong. However, this right here tells us that there's a corporate debt wall, a $2 trillion corporate debt wall, which is going to hit in 2024, spurring job losses. That's how we can get to that unemployment of 4%. So how could that happen? Well, it's called when like a debt wall or maturities when they hit. And we can see the numbers here. 230 billion. Annualized at 520 expires this year, 790 billion next year, 1 trillion in 2025. The chart just gets bigger. So that means that more people are going to have to refinance. And with the higher rates right now, man, that's going to hurt. We're entering a new paradigm, a new regime. And Larry Summers is looking for 475 on the 10-year note. A new 52-week high is how we had that crash signal before. That was the US 10-year note versus the S&P. But this might get delayed. I'm not sure. That's the bear story. We know the short-term bear story. We talked about that right now. We looked at the US yields. So we talked about the way that we could actually defer all of this until later. And I think that just trying to get a different perspective, because price is king. And for me, I've been trying to focus a lot on what can we actually know on a closing basis, meaning a weekly and monthly chart, but who actually won. I don't want to tell Jerome what he said. I don't want to interpret for him the way that he chose to say the words he chose. I just want to look at how the market reacted, because that's what we care about. Is it going up or going down? So with an inside bar, I'm deferring to next week. I thank you very much for watching. If you want to learn more about how to take all of these plans to make money, you can come trade with me for 14 free days by clicking on the link in the description or going to thealgo.com. If not, our weekend deep dive over here goes over another crash signal warning we gave a couple of months ago. And if you want to watch that, that would be greatly appreciated. If not, we will see you this week. Thank you for tuning in, and thank you for your support.